Okay, so we have seen quite a fall, in fact, maybe a crash of the S&P 500. And as you look at this graph, we're looking at almost like a 30% fall. It's come back quite a bit, but still quite a fall. Now, we haven't reached some of the peaks of previous years, and so as much as 30% sounds scary, it doesn't look nearly as bad as some of the other falls. But you have to understand that the further back you go, inflation plays a role. So if we look at the inflation adjusted history of the S&P 500, you can see that that fall really does take us back quite further to previous years than you might have thought before. So this is quite unprecedented in terms of a crash. And another part of how unprecedented it is if you look at that, let's say, dark blue line, the longest blue line going down, that's the Great Depression. So that was obviously the worst fall before there was a serious correction of the crash. And you have all these other types of falls. But if you look at the top left, that light green crash, that's what we're experiencing right now. So it has a speed that we haven't really seen before of how fast this thing goes down. The Great Depression kind of looks a little bit similar at the beginning in Black Monday, and time will tell how this crash really plays out. Like I said, we're getting a little bit of a recovery, but nevertheless, it's hard to really understand what's going on based off of previous history. What we can see, for example, is Volatility Index. So that is how fast is the stock market moving? How fast are people putting money in or out or whatever it might be? And we are getting levels similar to 2008, that crash. And you have people building models showing that the stock market is going to go up and down, and it might reach some level of the S&P 500 being 1,700 instead of what it used to be, around the 3,000. So but we have fallen almost half, and we've rebounded a little bit, which, even this graph might expect to happen before it falls quite a bit further. The point I'm trying really to show you this, all of this, is to really say if you're going to try and time the market and get in at the bottom, it's really hard because, first of all, it's unprecedented. Number two is we have a lot of self-fulfilling prophecies, but they're two different prophecies, right? We have one prophecy that is doom and gloom on one really far extreme with, God forbid, 2 million people dying in the States. And then you have other projections of only 20,000 or 200,000. And so these are self-fulfilling, right? Because people are going to invest based off of these two different options. And so it's really hard to know, first of all, which one's right, but also people are already making their decisions based off of which one's right, and probably there's something really in the middle that's true, and hopefully it's a much better situation than what people are expecting on the doom and gloom. But it makes it very hard to time the market because what is going to happen 2 weeks from now, people might have already factored into the market. And so sometimes you can have a company that has horrible earnings and you would think, oh, well, that stock's going to go down. Instead, it goes up because people were expecting it to be a lot worse. And so even bad news can actually improve the stock market if it's not as bad as people thought. And of course, you have this virus could mutate, or you could have this rapid technology development. And so things could change very quickly. And of course, there's something looming after this whole virus, and that is whether there will be a recession, which will dramatically affect things, right? If there's a recession, likely what will happen is the stock market might go into a bear market and prices might go down even further, and that would be a big delay from right now and what's happening with the virus. Right? The stock market could bounce back up, and then when it sees that businesses can't reopen and can't get to that same efficiency that they were before, might turn into a recession, which is that the GDP goes down quite a large number, and maybe even 2 times in a row. And people start taking money out of the stock market because they think, hey, this company's not doing as well as I had thought, even though the virus is over. So it makes it very tricky to time the market, and probably not a good way to invest. So what is a good way or an indicator to invest? And that's price earnings. That's a very useful indicator. And what price earnings are is when you have a share of a company, that share represents a small fraction of how much that company made. So let's use some really simple numbers. Let's say the company earns $100 per year, and you have 100 shares in that company. So each share has a gets an earning of $1. That's what it represents. You have 1% of that $100 when you have one share. I don't know, hopefully I explained that well enough. And the idea is, how much would you be willing to pay for the company? How much would you be willing to pay for that share? So a company that makes $100 per year, right? You're not going to pay $10,000 for such a company, but it would be ridiculous for you not to pay $100 for that company, because they're going to make that in a year. Why would they sell? And so, for example, maybe you would be willing to pay 10 times the earnings, right? So maybe the person would sell right now because as much as they'll make, $1,000 in 10 years, they'd rather have the $1,000 now. And so this is kind of the idea of price and earnings. And the idea is, what is a fair value for the business? Not what we were talking about before, what someone would be willing to pay or what someone would be willing to pay for your share necessarily, but looking at the business itself. What is a good price if I was going to buy that business? And you can divide that into shares. And so what we see in this kind of history that we're looking at, besides the massive spike in 2008, it's been mostly around that 20 and in fact below the 20. So people are usually willing to pay less than 20. Sometimes it'll go above that 20. And if we look at a log scale, now what does a log scale do? The log scale will kind of magnify the lower part of the graph and it'll shrink that spike. So we get to see that there really is a lot of movement in price and earnings, how much someone's willing to pay for a share. And that can go up and down, and we see now a little bit more clearly that it's really below the 20 mark usually, and on average around 15, which is, someone assembled pretty much a kind of bar graph of where is the price earnings usually. And so you can say around 15 to 16, you should hold your company. As it goes above that, as people are willing to pay too much for a company, maybe you want to start thinking about selling. And as it goes below that number, you might want to start thinking about buying. It means you can get a company for cheaper than it usually is. And this is all, by the way, ignoring, and this is very important, it is ignoring whether that company is going to do better or worse in the future. We're just looking at right now. What did the company make? How much would I pay for that company year after year? How much? So we're not factoring in what's going to happen. Is it going to do worse? Is it going to do better? And that is very important right now, because most companies will do worse, and that's why you're going to get it cheap right now. And the idea of getting it cheap right now is the idea that, yes, your stock will go down in value, but eventually it'll go back up. If you buy, for example, below that 15, well, people will pay more for it eventually. And, in the past 30 years, if we just cut off this price-earnings ratio for the past 30 years, so we can actually see that usually it's even above 20. So I'm not sure if we can get really to that 15. It would be really nice. You can see there was a little bit of a dip in around 2011 where it got down to 15, but that might be difficult. Nevertheless, we're going to try and get a good deal. That's the goal right now for one approach in investing during this crash. And now, just to be clear, why is it that price earnings have been up so much? Well, one possibility is due to low interest rates that have been going on. What happens is people need to try and make money on their money, and so they're more willing to buy a stock because they can't get money in bonds necessarily, or they can't get money in their bank account necessarily, and so they're willing to pay more for a stock and hopefully gain money that way. So it makes it a little bit different in the past, let's say 30 years, or 20 years, I should say, just in terms of what's been happening with interest rates. And that might be why in 2008 there was such a large price earnings, and how it fell during the crash. Nevertheless, another point in investing in the stock market is dividend growth. So here we have $1,000 of the first year that someone invests, and maybe they have a bank account that gets them a small dividend, meaning 3% a year on that $1,000. And after 31 years, they will have $2,000 if they keep taking that money out of the bank account. If they leave it in the bank account, so after 10 years, they will have $2,000. Why? Because each year you're getting more money, because you're getting, let's say, 3 or 4% on that bank account. The more money you have in it, the more money you earn off of that as interest. Now, imagine if that rate that the bank gave you grew, meaning the first year they were going to give you 3%, the next year they give you 3.1, 3.2, 3.3, 3.4. As long as you keep your money in the bank, they will keep increasing that dividend. And that's what the green line shows. And that really demonstrates very visually how picking a company that not only has dividend, but that has a growing dividend and one that you stay with for a long time can really multiply your return. And this is from a study over 20 years that shows that the return from the stock market, 93% of that was really from dividends, that people made money. And from those dividends, you can see 64% of that, 93% is from dividend growers. So we have a few approaches now. We've talked about it in the beginning, day trading, very hard to time the market, very difficult. Then we looked at price to earnings, which is this idea of getting a cheap company. That's a Warren Buffett type of approach or Benjamin Graham type of approach. Then you have dividends, just trying to make money off of companies that make money and redistribute to shareholders. Now, one thing we didn't talk about, which is growth stocks. I don't think it's necessarily a good idea in this market, although it would be nice. But the problem with growth stocks is people are investing in that company now because of future hopes and aspirations, even though the company might not even be making money. So, for example, Tesla, whether or not they make money, people are going to invest in them and they have a very high stock value because people think that they are going to be the future. That is a very risky business because who knows what other companies will do to compete, but also who knows about the current economic conditions and whether that company will be able to stay afloat. Maybe someone won't give them that loan. Even though it's Tesla, they'll be too scared, the bank, to give a loan to a company that they don't know what's really going to happen. And so if Tesla runs out of money or whatever might happen, it's a little bit risky. Now, dollar cost averaging, what is that? That is usually touted as this good idea, not always. But we're going to use it in a very simplified way. And dollar cost averaging pretty much is this idea is that through your life, you just keep investing in the stock market, $1,000 or $100, whatever it is, per week, no matter whether it's up, whether it's down. And the idea is that the stock market goes up over a person's lifetime in general, even if there's down times, whether there's up times. And you kind of just average out that upward trend. And that sounds nice. But we want to try and make as much money as possible. So while we're going in this kind of downward period, we're going to try and use dollar cost averaging. And the idea is we don't know where the bottom is, but if we keep investing a little bit, not all of our money, just a little bit of our money each week or each day, whatever you want to do, you will kind of keep riding that up and down, up and down, up and down, and you will get a pretty good price for wherever this stock market goes. So if I told you I thought the bottom today was, I don't know, the best price you'll ever get, yeah, of course you would invest all your money. What happens if someone's wrong, right? What happens if I'm wrong and it actually goes much further? Well, you've just wasted all your money. And so if you dollar cost average, that's not a problem because you'll just keep putting in more and more and more. And as the stock market goes back up, well, so that's not as good if you haven't put in all your money, but nevertheless, it's still better than missing that turbulent downward spin. So that's kind of what we're going to use, and so hopefully we'll average out with our inputs kind of somewhere closer to the bottom than if we just tried to guess. Now, what are the things we want to avoid in terms of stocks? Bankruptcies, of course, right? We don't want to deal with a company that's going to go bankrupt because, well, that will just adversely affect the price of the stock, and the company, of course, might actually have to close if it really is bad. Now, one thing that people I don't understand are looking at is, for example, companies like Boeing, the airlines, they're so cheap right now, and they know that they'll be bailed out by the government. But the problem is that the government will actually take a large portion of the stock, and what happens is the company actually issues new stock, and the stock owners, up until now, get diluted. And so whatever your stock, let's say you had 1% of the company, well, now that the government gave a loan to this company to bail them out, well, now your stock is now, instead of being 1% of the company, maybe it's now 0.1% of the company. And that's what happened to GM. And so people who own stock in GM, when the government bailed them out, which on one hand is good, the stock owners did not necessarily do well because of that. In fact, I think it was quite bad for most people. Also, If you have a company that pays dividends that might have to declare bankruptcy, that is very bad because they will not be paying dividends. And then people who invest in the company specifically for those dividends we discussed will leave that company. It'll have a much better, a very bad rating. And people who invest in dividends like to make sure that they have a history of paying dividends, the company. And so if there was a time where they didn't, well, those dividend seeking investors might not come back to that company so easily. So you really want to make sure that the balance sheet of the company has a lot of money. It can last even on bad years for a year or two or three would be nice, but that might not be possible. But that is important. Now, the next thing, what companies will survive a recession? Well, one is brands, even luxury brands like Ferrari. Why will they survive, assuming they don't go bankrupt? Well, eventually people will get money, and eventually people will think of those luxury brands like Ferrari, and they'll come back to them. If they lose business, Ferrari, that type of business will come back. And so that's one of the nice things about brands in general, and even luxury brands. Now, low-cost habits. So let's think about things like shopping. You have to go shopping, maybe your craft dinner or Coke. Those are low-cost habits that people will continue doing and enjoying even in a recession, and maybe even because of a recession. And so you can have stocks that actually don't go so badly during a recession, like a Walmart, like a Coke, like these things that people have to do or continue to do even during a recession. And so we'll try and kind of keep an eye out for those types of stocks.